in this example, we'll be doing practice exercise 15.4a that can be found in your textbook on page 695. We're going to do the journal entry to record the valuing of trading securities at fair value. The exercise tells us that on January 1st, 2014, the valuation allowance for trading investments had a zero balance. On December 31st, 2014, the cost of the trading securities portfolio was $212,500, and the fair value was $203,600. So we need to prepare the December 31st, 2014 adjusting journal entry to record the unrealized gain or loss on trading investments. So we are doing an adjusting entry as of December 31st. What they're asking us to do is compare how much we had spent, or the cost of our portfolio of trading investments, versus how much those exact investments could have been sold for as of our balance sheet date, which is December 31st, 2014. So they tell us that our cost of our trading security portfolio was $212,500. When they're talking about a trading security portfolio, it's just telling us that it's all of our investments that we have classified as trading securities in total cost us $212,500. The fair value, meaning what we could sell all of those investments for as of December 31st, 2014, was $203,600. Remember, we're not actually selling these investments. We're just comparing it to the value that we could have received had we sold them. So we're going to compare the two, what we paid for it versus what we could have sold those investments for. So we take our fair value and we subtract away the cost. And you will see that, in fact, our value of our investments has dropped by $8,900. So we have an unrealized loss. It is considered unrealized because we didn't actually sell those investments. Remember, on our balance sheet, we're always looking at just one particular day. It's a snapshot. So this is what the fair value of those investments were just on December 31st, 2014. That could change on January 1st of 2015. So again, it's unrealized because we didn't actually sell those investments. So that means we want our valuation allowance account to be a contra asset account, meaning that it's conflicting or bringing down the value of a particular asset. So we are going to debit our unrealized loss on trading investments of $8,900, and we're going to credit the valuation allowance on trading investments of $8,900. Again, if we're looking at our balance sheet presentation, how we would present this is that we'd have our investments in trading securities at cost, which again we know we had spent $212,500. It's gone down, so we'd have less our valuation allowance on trading investments or securities. of the 8,900 to show our investments in our trading securities at fair value of the 203,600. This gives outside readers of our financial statements a nice clear picture on how well our management is doing in terms of doing investments. Unfortunately, in this case, their investments have dropped as of December 31st, 2014. How this impacts our financial statements: again, our valuation allowance on trading investments is presented on our balance sheet. And in this case, it's shown as a contra asset account because our fair value was lower than our cost. If the reverse was true, meaning our fair value was higher than our cost of our portfolio, our valuation allowance account would be an adjunct asset account, meaning it would add to the value of a particular asset. The unrealized loss on trading investments would be shown on our income statement. Remember, we're dealing with trading investments, meaning the only type of companies that can hold trading investments are companies that do this for a living, meaning that their business is buying and selling investments. So companies like investment firms, mutual fund companies, and banks. Therefore, the unrealized loss or gain has an impact on their overall income statement.